Today, we witnessed a significant shift in the US-Japan interest rate narrative, with US dollar to Japanese yen breaking above the pivotal 160 psychological level. This surge follows a startling revelation. Japanese investors have pulled out a massive $29.6 billion from US Treasuries in the first quarter of 2026. In this segment, we'll explore the reasons behind this capital flight, the mounting pressure on the Ministry of Finance to take action, and why traders are once again eyeing the unwinding of the 2024 carry trade. As we entered today's session, the market was already on high alert due to the narrowing yield differential between the US and Japan. Since 2022, Japan's 30-year bond yield has skyrocketed by an astonishing 535%. This steep rise has fundamentally changed the landscape for Japanese institutional investors. The carry trade, once the norm, is now losing its appeal as domestic yields climb. Today, all eyes were on the 160 level, a threshold where the Ministry of Finance has historically shown unease. The major catalyst for today's movements was the confirmation that Japanese investors sold off $29.6 billion in US Treasuries and agencies during the first quarter of 2026. This marks the first quarterly net outflow since late 2024 and the largest since 2022. Compounding this, external factors have emerged. Fears of a blockade in the Strait of Hormuz have caused oil prices to surge, exerting additional inflationary pressure on Japan's energy-dependent economy. With domestic capital returning home and energy costs rising, the yen broke past the critical 160 mark, sparking renewed discussions about intervention. This isn't merely a technical breach, it's a fundamental change in how the world's largest foreign holder of US debt manages its portfolio. Market analysts in Tokyo are connecting the dots between yield movements and capital flows. The Kobayashi letter highlighted that this $29.6 billion sell-off ends an 11-quarter streak of net purchases, driven by rising inflation expectations. Technical analyst Priam charts pointed out the rapid pace of the JGB sell-off, emphasizing the 535% spike in the 30-year yield. Meanwhile, a quant strategist at Compass TT warned that escalating oil prices are fostering a panic environment regarding inflation. The consensus among analysts is clear. The yen is facing a multifaceted challenge: narrowing yield spreads, soaring import costs, and the technical breakdown at the 160 level. So, why does all this matter for global macro traders? First, the Treasury sell-off tightens global liquidity. Japan, holding $1.24 trillion in US debt, plays a crucial role. Any sustained exit diminishes demand for US duration, keeping US yields elevated. Second, for the Nikkei, yen weakness is no longer just a tailwind. Although it benefits exporters, the spike in energy costs due to rising oil prices is putting downward pressure on equity values. Lastly, the move beyond 160 compels the Ministry of Finance to act. Any actual intervention could trigger significant volatility, affecting not only US dollar to Japanese yen but also Nikkei futures and the broader US dollar to Japanese yen basis. In Tokyo, financial media are buzzing about the intervention watch. Reports suggest that the Ministry of Finance and the Bank of Japan are closely coordinating as the yen reaches these new post-intervention lows. There's a growing emphasis on cost-push inflation. Unlike the favorable inflation driven by demand, the current surge fueled by oil prices poses a serious threat to consumer spending. Local analyses are stressing that the 160 level is more than just a number. It's a political flashpoint that may push the Bank of Japan to accelerate policy normalization to defend the currency. From a positioning perspective, the risk is leaning towards a sharp unwind. Analysts are recalling the August 2024 scenario when US dollar to Japanese yen plummeted from 161 to 141 in just 3 weeks after a Bank of Japan intervention. Leveraged accounts are now weighing the profits from the carry trade against the looming tail risk of sudden Ministry of Finance action. Real money accounts seem to be leading the way out of treasuries, seeking higher yields from JGBs at home. This suggests that while the trend appears bearish for the yen, market positioning is stretched. making it acutely sensitive to any verbal or physical intervention from Tokyo authorities. For your watch list in the next 24 hours, start with the Ministry of Finance. Keep an eye out for any rate checks or verbal warnings signaling readiness to act. Next, monitor the 30-year JGB yield. If it continues its upward trajectory, expect further Treasury outflows. Also, watch crude oil prices closely. Should fears of a Hormuz blockade turn into a sustained rally, the yen will remain under intense pressure, regardless of any interventions. Lastly, pay attention to the US dollar to Japanese yen levels at 160.50 and 161.00. These points are where the 2024 unwind began, likely becoming magnets for volatility. In our baseline scenario, the Ministry of Finance continues aggressive verbal intervention, keeping US dollar to Japanese yen volatile around 160 without a massive drop, as the oil-driven inflation prevents a yen rally. The hawkish scenario involves a direct currency intervention combined with a hawkish signal from Governor Kazuo Ueda, which could trigger a 2024-style collapse toward the 150 level as carry trades unwind. In the dovish scenario, oil prices cool and the U.S. Treasury sell-off pauses, allowing the yen to stabilize without direct government action. Traders should prioritize protection against the hawkish tail risk, as the 160 level makes the status quo increasingly untenable for Japanese policymakers. In conclusion, remember these three key takeaways. First, the breach of the 160 level makes MOF intervention a critical market risk. Second, the $29.6 billion sell-off of treasuries underscores that Japanese capital is returning home as JGB yields rise. Finally, the surge in oil prices introduces a new and concerning variable for Japanese inflation. Keep a close watch on the 160.00 mark, as it represents a line in the sand. For more insights, subscribe to Tokyo Macro Daily for your morning updates on the Japanese markets. Trade safe.